Oil moved first, then gold followed, and now silver is starting to react. Curious. Not during a routine market cycle, not during a quiet economic week, but at the exact moment global tensions are rising again, across the Middle East, across global trade routes, and across financial markets that are already under pressure. Because when geopolitical risk begins to climb, markets rarely stay still, energy reacts first, currencies begin adjusting, equities hesitate, and precious metals begin to move. Gold usually leads that reaction. It reflects fear, central bank demand, and global uncertainty. But silver behaves differently. Silver does not simply react to fear, silver reacts to stress inside the financial system itself. Surprised, and when oil, gold, and silver begin moving together, markets start paying attention, because historically, that combination has rarely appeared during stable periods. It tends to emerge when something deeper is changing inside the global system. And right now, several signals are appearing at the same time. Energy prices are becoming more volatile. Safe haven demand is rising again, and physical silver markets are starting to tighten. Individually, none of these signals guarantee a major shift, but when they appear together, the structure of markets can begin to change. So the real question is not simply why silver is moving. The real question is something much larger. What exactly are global markets starting to prepare for? To understand why silver matters here, we have to start with the sequence markets tend to follow when global risk rises. It rarely begins with precious metals. It usually begins with energy, because energy markets react immediately to geopolitical uncertainty. Shipping routes become vulnerable, supply chains face disruption, and traders begin pricing in potential shortages. That is why oil is often the first asset to move when geopolitical tensions escalate. Energy is the foundation of the global economy. When energy risk increases, the cost of everything else begins to shift with it. But oil alone does not confirm systemic stress. Oil can move for many reasons: production cuts, weather disruptions, or regional supply shocks. The second signal usually appears in gold. Gold does not react to supply chains. Gold reacts to confidence, confidence in currencies, confidence in financial stability, confidence in the global system itself. And when investors begin moving capital toward gold, it usually reflects a search for protection, not from volatility alone, but from uncertainty about the future direction of the financial system. And that brings us to silver. Silver is often misunderstood as simply a smaller version of gold. But structurally, silver sits in a completely different position inside global markets, because silver exists in two worlds at the same time. It is a monetary metal, but it is also a critical industrial metal. Solar energy, electronics, advanced manufacturing, energy transition technologies, all depend heavily on silver, which means silver responds not only to fear, but also to economic stress and supply pressure simultaneously. And when silver begins moving after oil and gold, markets often start asking a deeper question. Is this simply another short-term reaction? Or is something larger beginning to unfold? Because historically, this sequence has appeared before several major shifts: energy volatility, safe haven demand, and tightening physical metals markets, a pattern that tends to emerge when global liquidity conditions begin to change. And today, those liquidity conditions are already under strain. Global debt levels are near historic highs. Interest rates remain elevated in many major economies. And geopolitical tensions are adding another layer of uncertainty to financial markets, which raises a critical issue, one that most investors rarely examine closely. What is actually happening inside the physical silver market itself? To understand why silver reacts so differently, you have to look beneath the surface of the market itself, because unlike many financial assets, the silver market operates through two very different layers. The first layer is the paper market: futures contracts, options, exchange-traded products. These instruments allow investors to gain exposure to silver without ever taking physical delivery, and this paper market is enormous. On major exchanges like COMEX, the total amount of silver represented by open contracts often exceeds the amount of immediately deliverable physical metal, sometimes by many multiples. Most of the time, that structure functions smoothly, because traders roll contracts forward, positions are closed, and only a small percentage of participants actually request delivery. But the stability of that system depends on one key assumption: that physical silver will always remain available when needed. And that brings us to the second layer of the market, the physical market. This includes industrial demand, bullion investors, national mints, and large institutional buyers securing physical supply. And over the past several years, demand in this physical layer has been quietly increasing. Solar panel manufacturing alone now consumes a significant portion of annual global silver production. Electronics demand continues expanding, and governments across multiple regions are accelerating energy transition programs, all of which require silver. At the same time, new large-scale silver discoveries have become increasingly rare. Many existing mines are aging, and a significant portion of global silver production actually comes as a byproduct of mining other metals, meaning supply cannot always respond quickly when demand rises. So when geopolitical tensions increase, and investors begin shifting toward hard assets, pressure can begin building inside this already tight physical market. Not immediately, and not always dramatically at first, but gradually, quietly, through rising premiums, tighter inventories, and increasing attention from institutional capital. And when those pressures start appearing while oil and gold are already moving, markets begin to recognize a pattern, because this combination suggests something deeper than short-term volatility. It suggests that the structure of liquidity in the global financial system may be shifting. And when liquidity shifts, asset behavior can change very quickly, which leads to the next critical question, one that sits at the center of the entire silver story today. What exactly happens if financial stress continues to rise from here? To understand where silver could move next, we have to step back from the metals market and look at the broader financial environment, because precious metals rarely move in isolation. They tend to respond to shifts inside the global liquidity system, and right now, that system is facing several pressures at the same time. Global debt has expanded dramatically over the past decade. Governments, corporations, and households have all accumulated record levels of borrowing. During periods of low interest rates, that structure can function relatively smoothly. Debt is cheap. Refinancing is easy. Liquidity remains abundant. But when interest rates begin rising, the entire system starts to feel the strain. Refinancing becomes more expensive. Debt servicing costs increase, and financial markets become far more sensitive to shocks. Now layer geopolitics on top of that environment. Conflicts disrupt trade flows. Sanctions reshape financial channels. Energy markets become volatile, and investors begin reassessing risk across multiple asset classes. This is why capital often starts rotating toward hard assets during periods like this. Not necessarily because investors expect immediate collapse, but because they begin preparing for uncertainty. Gold reflects that defensive positioning, but silver tends to move when that defensive positioning begins spreading deeper into markets, because silver sits at the intersection of two powerful forces, financial demand and industrial demand. If economic growth slows, investors may buy silver as a monetary hedge. If governments accelerate infrastructure or energy transitions, industrial demand for silver rises as well. In other words, silver benefits when both fear and structural demand appear at the same time, and historically, those conditions have often produced some of the most powerful silver moves in modern markets. But markets rarely move in straight lines. Volatility increases, short-term corrections appear, and narratives constantly shift, which is why the most important question is not whether silver will move at all. The real question is how markets behave if global risk continues expanding, because if oil remains volatile, if gold continues attracting defensive capital, and if physical silver demand keeps tightening supply, then the metals market may be entering a phase that investors have not seen in years, a phase where price movements are driven not just by speculation, but by deeper structural forces inside the global economy, and when those forces align, market behavior can change very quickly. Which leaves us with one final question. If this trend continues, how far could silver actually move from here? When investors begin asking how high silver could move, the answer is rarely simple, because silver is one of the most volatile major assets in the global commodity market. Its price can remain quiet for long periods, and then suddenly accelerate when market conditions change. We have seen this pattern before. In the late 1970s, silver experienced one of the most dramatic rallies in modern commodity history. Prices surged from just a few dollars per ounce to nearly $50 in a relatively short period of time. Then again in 2011, during the aftermath of the global financial crisis, silver climbed rapidly toward that same level, driven by a combination of monetary stimulus, financial uncertainty, and strong investment demand. But what makes the current environment interesting is that several forces are appearing simultaneously. Industrial demand continues expanding. Energy transition technologies require large amounts of silver. Global debt remains elevated, and geopolitical tensions are adding instability to financial markets. Individually, none of these factors guarantee a major rally, but when they begin reinforcing each other, markets can enter phases where price discovery becomes far more aggressive, One additional factor often discussed among traders is the structure of short positions inside the futures market. For years, silver has maintained a relatively large paper market compared to its physical supply. Under normal conditions, that structure operates smoothly, but when demand for physical metal increases rapidly, short sellers sometimes face pressure to close positions, which can amplify upward price movements. This type of dynamic is often referred to as a short squeeze, and when it occurs in a relatively small market like silver, price movements can become extremely fast. But even without extreme scenarios, many analysts are now watching the possibility of silver entering a new long-term range, a range potentially above the levels seen during previous cycles. Some projections suggest that if monetary uncertainty continues, silver could challenge the psychological level of $100 per ounce, and under more extreme financial conditions, some forecasts even point toward levels near $120. Of course, markets rarely follow predictions exactly. Unexpected events can always change direction. But the reason silver is receiving renewed attention right now is not simply the possibility of higher prices. It is the broader signal that silver may be sending about the global financial system itself. Because historically, when energy markets become unstable, when gold begins attracting defensive capital, and when silver follows that move, markets are often entering periods of deeper transformation, periods where liquidity shifts, risk is repriced, and the structure of global finance begins to evolve, which brings us back to the central question of this entire discussion. Oil moved first, gold reacted next, and now silver is starting to move as well. So the real issue may not be how high silver goes. The real issue may be what these markets are collectively trying to tell us about the direction of the global economy, about the stability of the financial system, and about the changes that may already be unfolding beneath the surface of global markets. Because sometimes, before major shifts become obvious, markets quietly begin sending signals. And right now, silver may be one of those signals. Markets rarely announce major shifts clearly. They rarely send a single obvious warning. Instead, signals tend to appear gradually, across different assets, different regions, and different layers of the financial system. Energy markets begin showing volatility, safe haven demand slowly increases, liquidity becomes more sensitive to shocks, and certain commodities begin behaving differently than they did before. This is often how systemic changes begin, not with a sudden collapse, but with a change in market behavior, a period where correlations shift, risk moves in unexpected ways, and investors start paying attention to signals that previously seemed unimportant. Silver has played this role before, not as the cause of financial stress, but as a reflection of it, because silver sits at a unique intersection between industrial production, energy infrastructure, technological demand, and monetary uncertainty. When multiple parts of the global economy begin shifting at once, silver often responds, sometimes quietly at first, sometimes violently later. And today, several of those structural forces are aligning again. Energy markets remain sensitive to geopolitical developments. Global debt levels continue expanding. Central banks are navigating the difficult balance between inflation control and financial stability. And investors around the world are increasingly focused on resilience rather than pure growth. In environments like this, capital often begins repositioning away from purely financial assets toward tangible assets that hold value across economic cycles. Gold has traditionally been the primary destination for that shift, but silver, because of its industrial role, can become the next stage of the reaction. And when that happens, price movements can accelerate far faster than many investors expect. But the most important takeaway may not be the price of silver itself. It may be the story behind the move. Because when oil, gold, and silver begin reacting to the same global pressures, markets may be signaling something deeper, something about rising uncertainty, about tightening liquidity, and about the possibility that the global financial system is entering a new phase, a phase where volatility becomes more frequent, where geopolitical events influence markets more directly, and where investors are forced to rethink assumptions that have held for decades. Silver alone will not determine that outcome, but it may be one of the clearest reflections of the forces currently shaping global markets, which leaves one final thought to consider. If energy remains unstable, if financial stress continues building, and if demand for physical metals keeps increasing, then the movements we are seeing today may not be the end of the story. They may simply be the early signals of a much larger shift. For most investors, silver is often treated as a secondary metal, less discussed than gold, less visible than oil, and often overlooked during calm market conditions. But history shows something interesting. Silver rarely attracts attention during stable periods. It tends to become important when the global system begins changing. because silver reflects multiple forces at the same time: energy demand, industrial production, technological development, and financial uncertainty. When these forces move together, silver can become one of the most responsive markets in the entire commodity space, and that responsiveness is exactly why analysts watch it so closely during periods of rising global risk. Right now, the signals appearing across markets are still developing. Oil volatility has increased, gold demand has strengthened, and silver has started to react. None of these movements alone confirm a major shift. Markets can always stabilize. Geopolitical tensions can ease. Economic conditions can improve. But when several indicators begin aligning simultaneously, investors start paying attention. Because structural changes in financial systems rarely appear overnight. They emerge slowly, through signals, through volatility, and through assets that begin behaving differently than expected. Silver may be one of those assets today, not necessarily as a prediction, but as a reflection of the forces currently shaping global markets. For now, oil, gold, and silver are all responding to the same rising pressures. And if those pressures continue building, the reactions we are seeing today may only represent the beginning of a much larger story. Sometimes the most important signals in global markets are not the loudest ones. They are the signals that appear quietly, before the majority of investors begin paying attention: a shift in energy volatility, a slow rise in safe haven demand, and a metal like silver beginning to move after a long period of relative calm. Individually, these developments can seem minor, temporary, even coincidental, but markets are a complex system, and when multiple signals begin appearing at the same time, they often reflect deeper structural forces already unfolding beneath the surface. Today, global markets are navigating a difficult environment: rising geopolitical tension, elevated debt levels, tighter financial conditions, and growing uncertainty about the future direction of the global economy. In this environment, investors are constantly searching for signals. Signals about liquidity, signals about risk, signals about where capital might move next. Oil is signaling geopolitical sensitivity, gold is signaling defensive positioning, and silver may be signaling something more complex: a market where industrial demand, financial uncertainty, and tightening supply conditions are beginning to intersect. Whether that intersection leads to a major shift or simply another cycle inside the commodity markets remains to be seen. But one thing is clear: when energy markets become unstable, when gold begins attracting global capital, and when silver starts reacting as well, markets are rarely entering a quiet period. They are usually entering a moment of transition. And the signals appearing today may be the early signs of that transition already beginning. So the next time silver moves, the real question may not be how high the price will go. The real question may be what the global financial system is trying to tell us. To fully understand why markets are reacting this way, we have to zoom out even further, because what we are seeing in oil, gold, and now silver is not happening in isolation. It is unfolding inside a global system that has been changing for years. Over the past 2 decades, the world economy has become increasingly interconnected. Supply chains stretch across continents. Financial markets move capital across borders in seconds, and geopolitical events can ripple through global markets almost instantly. But this interconnected system also carries vulnerabilities. Energy disruptions can spread quickly through global trade. Financial stress in one region can tighten liquidity everywhere, and geopolitical tensions can reshape entire economic relationships. That is why markets watch commodities so closely. Commodities sit at the foundation of the global economy, and they power industry, they fuel transportation, and they support the infrastructure of modern technology. When commodity markets begin behaving differently, they often reveal shifts occurring deeper inside the economic system. Oil volatility reflects geopolitical risk. Gold demand reflects monetary uncertainty, and silver, because it connects both industrial demand and financial sentiment, often reacts when those forces begin converging. That convergence may be exactly what we are starting to see today. Energy markets reacting to rising geopolitical pressure, precious metals responding to financial uncertainty, and investors gradually adjusting their portfolios toward assets that historically perform well during unstable periods. None of this guarantees a dramatic outcome. Markets have navigated uncertainty before, but when multiple signals begin aligning, investors tend to look more carefully at the patterns forming across different asset classes, because sometimes major financial shifts do not begin with dramatic headlines. They begin with subtle movements across markets, movements that gradually reveal how global capital is repositioning itself. And right now, oil, gold and silver may be offering a glimpse into how that repositioning is already beginning, which leaves one final perspective to consider. If these signals continue strengthening, the story unfolding in the silver market may not just be about metals at all. It may be about the next phase of the global financial system itself.